Hey traders, welcome to the live Q&A with me. I'm Raghee, and for the next 20 minutes or so, we're going to take questions about the symbols that you want to take a look at, the questions that you might have about trading, and no questions too big or too small. We're just going to be keeping it to about 20 or 30 minutes, so bring it. This is a very interesting year so far, and the two time frames that I have up on the screen right now are longer term in nature, right? I mean, obviously, we're not looking at a ton of intraday action on a Sunday evening, but the equity markets, while they will be ringing the bell at 9:30 tomorrow, the futures markets are just now waking up for the Asian session. And so what that means is we've got a very early look at where futures are opening after what was a fairly dramatic sell-off on options expiration Friday. I'm not going to be surprised to see OpX have a volatile session. So for those of you that are wondering, hey, Rag, what about OpX for January? What did OpX for January look like? And that was actually I'll show you right here, the 17th, which is right there. So not really as dramatic a third Friday of the month for the month of January. But, I will say also it was an unusual January because we're on that 4-year cycle. And, if you think about where we have the kind of volatility on the 4-year cycle, it's going to be after inauguration. So we'll see what March looks like. Jot it down. It's going to be March 21. So a lot of volatility on OpX. OpX is a bubble unto itself. It's an island unto itself. It operates in sort of a bubble, which is to say that the psychology of that day, while it might have been influenced by whatever the news was, whatever the headlines were, primarily OpX is about one main idea, and that is where does price in a stock, in an ETF, have to close in order to render the most number of options worthless. Now, there's always that question of who's they. It's pretty simple in the context of if market sellers, which are typically big institutions, big money, if you will, if they can manage to move based on filling orders and all the things that they do, because remember, part of their job is to fill orders for their clients. And if they can do so in a way, moving price to places where the options that they've written, that they've sold, will be very low value or worthless, of course they're going to do it. That's not anything sinister. It just makes sense. You're right. If you have that ability, they're going to do it. So we know this. This isn't about Max Payne per se. This is a process that I teach where we take a look at the most number of options on either side of the option chain. Right? So let's say we're looking at the SPY. We went over a little bit of this last week. So take a look at the option chain. You'll see where most of the options are, the put or the call side. One side is going to have an edge over the other. Sometimes it's really obvious, sometimes it's not. But you take a look at that, and then all you do is just look at what price that symbol has to close at to render the largest number of puts or calls worthless. Now, if it's a twofer where you can have a large number of puts expire worthless and a large number of calls, great. That is usually where it's going to close. So don't worry about the why and the, whatever of it. Just realize it is a phenomena of price action. Just like we have presumed that the pit below the Wednesday to Friday before options expiration has a certain phenomenon. Just like we know there's a rhythm to what happens in the first handful, say 2 or 3 trading days of the month versus the last 2 or 3 trading days of the month. We know the end of the quarter has a certain rhythm too. So this is just another one to keep an eye on, right? Okay, so that being said, we're not gapping down. There's not further panic. The weekend news was actually rather sedate. And here we are coming up off the lows. And you can see here price action sitting in a very early part of the session, just above the previous session close and the previous session low, putting it mildly in bullish territory in relation to that line in the sand that I call it the previous session close. And I use that cash close. All right, so that's where we are. You kind of look at what happened on Friday, move into today, and we'll be taking a look at what Monday morning looks like. All right, so with that being said, the first question up here for our Sunday show comes from AM, who asks, how can I tell the difference between an opportunity to buy the dip or if it's catching a falling knife situation? Sure. The first thing I want to make sure it's super clear. The game that traders play is a game of probability. It's not a great game of certainty. Nothing is 100%. Nothing is going to happen all the time, right? So it's a game of probability. What is more likely to happen versus not most likely to happen. So I kind of look at trading as probability and possibility, right? I want more probability. I want less possibility. That being said, what's more probable would be looking at a symbol. If we're looking at the difference between buying a dip and continuation, right? So what's the difference between buying a dip and catching a falling knife? All right. To me, Walmart, this is just, I'm going to separate the two out. Walmart would be trying to catch a falling knife. Could it bounce? Sure, it certainly could. But the probability is lower. And probability means if I look at 100 setups, like Walmart's reaction to earnings, which was in an uptrend before earnings, I leave earnings symbols alone when that spectacle goes off. But this would be a little bit lower probability. I'm not saying it may not go straight up, but the probability of that is lower. Whether that might be something like a new mining, right? Same thing. The probability of just selling off on earnings and then rocketing back up higher it's possible, but it's not probable. Could it resume the uptrend? Absolutely, but let the dust settle. So that's possible versus probable. All right, take something without earnings. Take, say, a pullback in Citi, right? Is Citi still a trend? Yes. Is Citi pulling back to the volatility zone, right? Yes. Is it pulling back to a mean reversion? Yes. I don't love the yellow candle here, right? I really don't, but it's slightly more probable when I look at, say, 100 instances of this particular situation where we have a trend, no earnings to disrupt the typical flow, and boom, and another thing I could do, here's another thing we could do. Part of what I wanted to talk about here today was understanding things like flow. Flow is what is the attention, what is the movement in a particular symbol. So if I'm looking at the flow in, say, financials, right, you can see the inflow Feb 20, that week of Feb 20 was positive 6.95 million. I would like to see flows like that. I would like to see inflows. Dollars are not just attention. Dollars are direction. So if we have an uptrend and we have a pullback and we have positive flow, again, nothing is all the time, but probabilistically, I would look for movement to the upside. And that's the difference, right? You might say, Rog, can you give me the difference in a word? Yes, trend, right? Trend. Is it trending or not? And the other part of that is, can you find movement lower that you can buy? And that's where we go into non-trending or sideways environments that are choppy. And is it oversold? Now, here's the thing. Most traders run into the problem of not having an instant and live way to assess a trending symbol and that time frame individually, right? This isn't just about the daily. We need to make assessments like that, AM, right, on a 5-minute time frame, maybe an hourly time frame, maybe a weekly time frame. So it's not just a conversation about a daily. And the same tool that I would use on a daily is the same tool that I would use on a 5-minute time frame. And it's an instant way to understand, are we trending or not? And if we're not, is it overbought or oversold? Or is it heading towards one of those extremes? And that's really the way that I look at it. All right. Next up is a question on GMAB. All right. GMAB is in a big downtrend on the weekly chart. Earnings seem to have given it a little bit of a boost. Here's a great example, kind of going back to AM's question with Young's question, which is trending versus not trending. This is a non-trending environment. Let me show you how I assess that. So at the very bottom of this chart, I have an indicator running right there. That's called a multi-structure. Multiple structures. Are we in an uptrend, downtrend, sideways range, choppy sideways range. So there's a narrow sideways range, there's a choppy sideways range. So which one am I in? Uptrend, downtrend, narrow sideways range, or choppy? So first thing is to figure out if we're in a trend or not. And if we're not, then process of elimination brings us to a non-trend. This is a non-trending environment. All right, next thing I'll look at, here's resistance. This is all automated, right? So there's my resistance level. And this right here, I know it has a silly name, but I've always wanted, I call indicators secret squiggles. Most of them are black boxes. None of mine are. I'm happy to tell you what the indicators are basically measuring. And a secret squiggle is looking at a variation of a slow stochastic, right? Black boxes don't work. I'm not here to confuse the issue, but everyone should get a vague idea of what this thing is sort of built upon. Lots of indicators are built upon other things. For example, my structure is based upon certain period lookbacks using a variation of an exponential moving average. So while I tweak the code, that's basically what it's built on. That's the basic framework of it. This is indeed overbought. So I've got overbought, which is another way of saying resistance. I've got a ceiling, which is another way of saying resistance. What are other ways of saying resistance and support, gang? I've got a ceiling, right? What do I have up here typically at a ceiling? I have sellers, right? What do sellers bring? Sellers bring supply. It's all the same conversation, gang. And in this case of the indicator, it's overbought, right? It's another way of talking about something that could be at a level where it's likely not to keep going further. And the reason I would say that is we're not in a trend. If we're in a trend, uptrend, the likelihood of higher highs and higher lows is more probable, right? Now, is it possible that we break out? Sure, it's possible, but is it probable, right? And that's what we always are kind of going back and forth about. And that's GMAB. It looks overbought. I would not be buying it up here. I would wait for a pullback. And at that point, if there is a reason to buy, it'll be somewhere in the middle to lower quarter of the zone. And then this level of resistance here, right? Resistance, sellers, selling, supply, whatever you want to call it, it's a ceiling. I would use this as a first target. And the only way to use this as a first target to pay yourself is to wait for a pullback and then look for a resumption back up to that level. And that's basically the difference between trending setups and non-trending setups. So thanks for the question. All right, next up, Alex asks, GE on the daily. So Alex is a member of our Sector Secrets Mastery. And some of the conversation around GE really was hinging on this XLI conversation, and even I'd say secondarily, the Dow. We've got three pretty good names in the XLI. GE happens to be one of them. I say good, they're trends. But what we have here is a lack of alignment. So if we think about the hierarchy of trading, the top is going to be usually the index. Now, if you're trading oil stocks, it might be crude oil. If you're trading gold and gold miners, gold mining stocks, it might be the actual futures contract. But for most equity traders, we're looking at an index. And then after that, we're looking at a sector. And then lastly, we're looking at the stock, in this case, GE. So remember, the most important alignment, right? Now, if XLI is sort of wobbly and the Dow has been sort of wobbly, but GE is moving higher, that lacks alignment. It doesn't mean that it's not a decent trade, but it means that it's going to have to work a whole lot harder to move higher because it's in sort of a problematic or choppy waters, right? Rather than the waters just flowing in one direction at the index level and flowing in one direction at the sector level, and then the stock just kind of goes along with it, GE is not in that area. The other thing that I would avoid GE, and we didn't trade GE on Friday, even though I love this trend, is this is a candle of unusual size. This is a candle that's larger than basically the previous 5 candles that came before it. And once I get a candle of unusual size, I will wait, right? There's no harm in waiting. I will wait to see if it normalizes, gives me a price pattern like an inside day. That one's great, gives me a price pattern like a minor low. I'll look for price patterns now that we've had this massive sell-off. But there's a lot of things about GE I do not like, even before I get to that GE stock, right? So those are things that I'll be looking at. But yeah, we need to wait for it to settle. Alex, just like you said, we need to wait for this thing to settle down. There's too many things that would keep me from being that opportunistic about it. All right, so going into the next question, Jason says, what are my favorite sectors going into this week? Yeah, that's pretty simple. So the sectors that I'd be looking at going into this week would start with a 1 month relative, or even a month to date relative performance, which is to say, what are the symbols up until this point in February, or up until this point over the past 30 days? What are those symbols that are still at the top of the list? I'm not bearish. I'm not looking for symbols down at the lower part of the list. I'm looking for, say, the top 5 to 7 sectors. You can see it really easily, starting with gold miners, staples, energy, utilities, semiconductors, technology. Now, that does not mean automatically that's where I'm going, right? That does not in any way mean that's where we just sort of gravitate to. But what it does mean is I'll look in those groups of stocks for relative outperformance first, right? I'll look for stocks in those groups, preferably heavily weighted. Say, hey, in gold miners, is there an uptrend? In staples, is there an uptrend that we like? In energy, is there an uptrend that we like? And that really is, so much of what I look at from the perspective of my own trading. And this is probably a really good time to mention that the class that we're doing over the next 11 weeks, so it's 12 weeks of class. And what we're doing is going through, and the reason this kind of popped in my head, so thank you for the question, Jason, is these are all the topics, by the way, how to set up my scan and understand relative performance. So after I go through that process, Jason, what I'm going to do is that I'm going to then go, let's say we're talking about staples, right? I mentioned that was in one of the top groups. Now I set up a scan like this, and I ask myself, all right, what are the relative outperformers within staples, right? Is Walmart one of them? No, Costco is, Coke is, Philip Morris is, Altria is, Mondelez is, and actually Coke, Altria, and Mondelez are longer term share positions that we have in the sector secrets mastery. Now, for swing trades, as opposed to position trades, you can see which stocks are in a trend. So that's part of the process right there, right? Scanning. The other part of it is what we just discussed, alignment. And there's nuance to this. There's indicators I use for this. There's a process, a repeating process that I use for this. So take a look at this topics that we're going to be covering through the class. And instead of doing all of this, because this is fairly daunting, I think what we've found is I could do an entire class on how to use volatility, right? That's one of the main keys to my trading. I've decoded historical volatility. I've automated it, and there's zones on my charts. Many of you will see them. It's the gold and gray zones on my chart. So, I could dedicate a whole class to this, right? So rather than trying to squeeze all of this into, say, 4 hours and one day, what we've done is we're going to spend 1 hour, one whole hour on each one of these topics 1 week at a time. How to position size, understanding risk, and trading size with options. How many traders out there say, Rob, I don't know how many contracts I'm supposed to trade. I don't know how to understand risk and size when I'm putting on an options trade, right? There is a formula to it. There's a formula that is based on your account size and therefore what kind of risk you can take in it, which then tells you how many contracts, how many dollars worth of contracts you can trade. So there's a lot of topics here. We're going to do the same thing. By the way, we will be doing the same thing specific to futures because it's a little bit different, because unlike a tick in trading options, which is the same whether you're trading NVIDIA or whether you're trading Coke, futures are a little bit different. Each tick is different in the Russell versus the Dow versus gold versus the NASDAQ versus the S&P. So it's a little bit different. So we're going to be going through all these different topics, one a week for the next, for 3 months. We'll be doing this over the course of 3 months. And when you think about the little pieces that, whether that be AM's question about the difference between chopping and trending, or in the case of, should I buy a dip or is this not a dip at all? Is it a trending market or a non-trending market? That's where these basic things where we presume we think we know, that's where we get into trouble. I see a lot of traders who understand strategy really well. Right? They understand when to buy a call, when to buy a put, and they put those on really well, or maybe it's a spread, what have you. Sometimes it's doing this thing well timed, but in the wrong name. And that's where, when I look back on traders struggling to grow their accounts, a lot of times the problem isn't knowing how to buy a call, although for some traders, being able to route your own order flow using price conditional orders like limit orders and stop orders, understanding when to hit the bid, when to use the ask, things like this might be a little bit confusing, and it can cost you money. That spread can be risk. That spread can be giving up reward. So we try to direct our own order flow. But apart from that, what I find a lot of traders struggle with is understanding, hey, is this a symbol that I need to leave alone while the dust settles? Or is this a symbol that's chopping? Or is this a symbol that's trending? And that's the watch list building. That's the alignment part of the conversation or even like Jason's question, what are the sectors that have a probability of following through? All right, can we take a look at the NASDAQ? Sure. So NK futures are opening up right now, and we are well off, right? I shouldn't say that well off, but we are off the lows. OPEX is its own psychology, running lower on OPEX. And by the way, again, you might say, was OPEX that messy? Please remember, in an environment of algos, in an environment of probably the most retail trader participation we've ever had in modern markets, momentum begets momentum, right? Sell-offs tend to get your average retail trader. By the way, none of you are average retail traders if you're with me on a Sunday evening doing some Q&A, right? So your average retail trader is thinking, oh my gosh, I need to get out, or oh my gosh, I need to short sell the symbol, right? So they're chasing momentum almost always. And then you've got algos that feed on that. Algos feed and even fuel a lot of the hyper volatility. If you're wondering, yeah, Rog, how do we understand volatility? That's where historical volatility, not an average true range. It looks back over the last 7-day trading days, the last 14 trading days, or I seldom see this, or even the last 21 trading days. I'm looking back 6 months worth of trading days on average. And that's where a lot of traders get into trouble. They have no real bearing for historical volatility. They might have a really short-term view of volatility, like a 7 setting on an ATR, which is markedly different than saying, hey, what's the nature of the NASDAQ today, right? And so those are things to keep in mind. NASDAQ's up off the lows, and as long as it stays up off the lows of 21,650, call it 653, this is above that previous session low, and the close, if we can stay above 21,660, would be phenomenal. That's the previous session close. We're in the bullish hemisphere for now, and it does look like the sell-off on OPEX wasn't alluding to or foreshadowing panic. It's just the nature of a very volatile day, a day that we know we're going to have volatility more often than not, probability versus possibility. Someone says, Rob, third Friday of March, we're going to see this? Possibly, probably, right? Third Friday of April, probably, right? Is it a possibility? It's a probability. So we look at what is the most likely scenario. And yeah, third Friday of the month can be a lot like this. By the way, so can the end of the month, especially if it's the end of the month that happens to be the end of the quarter. March is going to be one of those situations. So as much volatility as we might see on that third Friday of the month, the end of March could be wild, because that's a very high probability time for when we see a lot of rebalancing of positions. You're going to see rebalancing of whatever investors and position portfolio managers, et cetera, funds, whatever they thought they were going to deal with on January 1, they're really going to rethink whether they want to be in those sectors, in those stocks at the end of the quarter. So very big time for that kind of volatility. And that'll be this next month. Not the end of this month, the end of next month. All right. Next up, JP Morgan. Yeah, there's a lot to like in financials. It's really a lot of different setups that we could look at in financials. I ultimately went with Citi. We could have easily gone with financials themselves. XLF could have easily gone with JP Morgan. This is where it's just a matter of which stock has the most resilience. And then sometimes it's just a matter of, do you want to bet on an individual boat or the overall tide? And often I like to be in the tide if enough of the stocks in that group are showing signs of strength. And I probably could have gone with either on, no one knows what's going to happen next, 2020 hindsight, right? However, seeing that Berkshire, JP Morgan, Visa, MasterCard, that would make financials a pretty tempting place to be. Ultimately, though, I went with Citi. It's a lower weighted stock in the group. It's a very affordable stock in the group. It's a very liquid stock in the group. And it's a little less tethered to what financials on the whole are going to do. And that's where I ultimately went for the setup. JP Morgan, of all those names, I'll tell you, the one that I think is the best is probably Visa. Visa, MasterCard can be a liquid, but probably Visa. It responded to the sell-off in the most muted way. In other words, it went down because the tide was going out, right? Outgoing tide, that boat's going to sink a little bit in the water, rather than the massive sell-offs that we saw in other places, or candles that have red, like American Express. That's a big no. Morgan, big no. BlackRock, Blackstone, those are no's. So it's just, we're going to see if the group can move higher. But yeah, definitely like that Citi, and I'm still in Citi from that entry. And by the way, if you're a member of the Sector Secrets Mastery, again, or if you're looking to be a member of the Sector Secrets Mastery, you can check that out at simplertrading.com/immersion. And I'll only be out of a symbol if I lose a certain percentage of what I paid for. So for those of you that want to know what I paid for that Citi, it was in the free video, and I did send it, of course, as the alert out to members. You can check that out, and we'll see what we've got on Monday morning. As far as when does registration close, there is going to be a hard close. I know a lot of people say that. There is going to be a hard close because once the class really gets underway, I don't want people having to play catch up. So Wednesday at noon is going to be the next session. So Wednesday, I believe Wednesday is the cutoff for the class. And if you check out this link here, you'll see we have class only, class but certain tools, class plus longer access to the mastery. All of them have, I'm trying to remember what the different I can't remember off the top of my head. But yeah, check out that link and you'll see the 3 choices that you've got. And the hard stop will be, I believe, Wednesday, if not Tuesday night. So we know who we've got in the class going forward. Thanks for the question. All right, next up is, hang on, gang. I'm going to run out of time before I can get through all the questions. But as far as copper and bonds, all right, so copper I do like. There's a lot of reasons why the metals and mining XME has been quite strong. I've been talking about that sector and the Sector Secrets Mastery for quite some bit, but it's really been quite volatile. And copper and gold, if I had to say copper and the metals and mining, or gold and gold miners, I'd probably stick with copper at the futures level because there's no real liquid ETF alternative for copper. Probably the better place to be is gold and gold miners. And by the way, all my cards on the table, I still have a position in gold miners. Oh no, I don't. I have a position in gold. I still have a position in gold. As far as bonds go, and we'll wrap it up here with bonds. So bonds this is that example of, is this trending, right? Or is this choppy? So notice, let's go down here. All right, there's 2 rows here. The top row is momentum. The bottom row is trend. And it's really the bottom row that I'm most interested in. It tried to turn into a trend, but failed. So right now, as you can see, well, in case you don't know, gray means we're still moving sideways. So neutral momentum, neutral trend. So then I go up to the candle. Well, the candles are mostly green. And when I get 5 of these top tier candles in a row, 1, 2, 3, 4, 5, 6 top tier candles, 7, sorry. Once I get that, that's today's candle. I know that I'm long calls or nothing. I'm long bonds or nothing. Once I've got those 5 green candles in a row. So I don't have a trend, which means the selling pressure here, there's that resistance, right? Resistance, we know it's also sellers. It's a ceiling. What do sellers bring? Sellers are supply, right? There's so many ways to say the same thing. These are all the same thing. The question is, how is it being calculated, right? Anyone could say this is resistance. Why, right? Anyone could say the sellers are coming in. Why? Anyone could say this supply or this the ceiling. Why? And in this case, the why for me is twofold. One, I have a automated price pattern here. Okay. There's actually a second reason. You can see right in here, I have this yellow zone right in there, and that's volatility. The second why is there's a volatility resistance level right there. And that's why I would expect that to be resistance going forward. So all I need to do is be patient enough. It happened on Friday, by the way, is let the green candle sink into that gray zone and see if it may not move higher to either the yellow zone or that yellow resistance level. One is a price pattern. The other is a volatility zone, right? And that's really how that works. And that's what I would say the reality is on bonds. Try to find a green candle in the gray zone. And as it's moving higher, respect, right? What's going to happen likely. Again, probability versus possibility. Just look at, right, how to manage that. All right. Hey there, Jeff. Jeff says, don't hesitate when they say hard close, they mean it. Yeah, it's true. I want to make sure everyone is in for the class, so no one's coming in 3/4 of the way and feels lost. Yeah, I appreciate that. Jeff says, Raghee will educate you to teach you how not to blow up. I love how you said that, Jeff. I love how you phrased that. It's not about me telling you all these grandiose things like, you're going to trade minutes a day and hang out and you don't have to look at the charts and what other, this is so easy. And I'm never going to say those things. I think we can make trading automated, which makes it easier and less subjective and frankly, less emotional. But there is some work involved, right? We're going up against brilliantly programmed computers, brilliant traders who aren't maybe that brilliant, but have lots of money. We're up against some serious things. So for me to say, hey, this is easy, I don't want to ever say that this is going to be easy, but there are ways we can make this easier. There are ways we can measure the things that matter, and that's going to allow us to manage risk, because that is the number one job, gang. So those folks who say, hey, look at my win rate, look at my winners, look at how easy this is, run, right? This isn't easy, but it is doable. And it's doable when you learn that risk is the thing to manage. What do they say about the Super Bowl? A good defense wins the Super Bowl. They'll tell you going into a Super Bowl, the team, and sorry for anyone out there where that Super Bowl might have been a sore topic, but I think it's such a great analogy, right? The team that has the turnovers, that gives up the most turnovers, is going to do what? They're going to be the ones that lose. So even the Super Bowl reminds us, the team that manages risk ends up with that ridiculously big ring on their finger. And that's kind of the same idea with trading. Manage risk. Have a great defense. Defense wins championships. And that's the way we think about it. And I appreciate that, Jeff. Thank you. Gang, we're going to be right back live tomorrow. Go enjoy the rest of your Sunday. Thank you very much for being here on a Sunday evening. Again, that's what makes you exceptional. That's where I'm so grateful that you all are saying, Rog, there is a way to be good at this. And maybe I need to start when everyone else is still at the barbecue or whatever they're doing. You get a slight edge by educating yourself and getting ready for the week to come. And we'll be doing that again at 9 a.m. right here at the Simpler Trading YouTube channel and at my YouTube channel, Raghee Horner, with charts and coffee, right? So come caffeinate and dominate with me at 9 a.m. Be good to each other, gang. I'll talk with you soon.